mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Hello and welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, this podcast is designed to help you go from beginning to dividend. My name is Ren. I am solo in the studio today because I've just come off an interview with a pretty epic guest, someone people may be familiar with, or if you're not familiar with him, you may have heard of his book. I sat down with Christopher Mayer, who wrote 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. These are stocks that take every dollar invested and turn it into more than 100. That's pretty exciting. I mean, at its core, that is why we invest. And so Chris and I looked back at the history of the US stock market and looked at the companies that have delivered those returns. And spoiler alert, it's not just a handful of companies that have delivered that. In the period that Christopher looked at, from 1962 to 2014, 365 companies returned at least 100 to 1. So it's pretty inspiring, and it's certainly got me excited to get back into more individual stock research and find some of those 100 to 1 potential companies. So let's get to that interview now. But before we do, one piece of housekeeping. If you have read Christopher's book or you are looking for another investing book, may I suggest the new book from Bryce and I, Don't Stress, Just Invest. It is our outline of the absolute simplest way to invest, how to automate it, and why that is enough. For us, building that core portfolio and automating it and having it ticking away in the background is 101 when it comes to investing. For Bryce and I, what we want to do is set that up, automate it, and then spend our time trying to find these 100 baggers. But we can be confident that that core portfolio is ticking away in the background. So the book is available for pre-order. It's hitting shelves on the 22nd of August. So please, if you enjoy the podcast, if you enjoyed our first book, Get Started Investing, would love it if you got around the pre-orders. So Amazon and Booktopia and booksellers know to stock the shelves full. But look, with that, let's get to my interview with Christopher. And as we always say before we get to it, while we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice only. Seek professional help if you feel like you need it, and make sure you're always doing your own research. But with that, here's Christopher Mayer, author of 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. And he's also the co-founder and portfolio manager of Woodlock House Family Capital. Chris Mayer, thanks for joining me today on Equity Mates.
Hey, Alec, good to be on with you. Thanks for having me.
So we're big fans of your book, 100 Baggers, here at Equity Mates, and I'm sure a lot of people listening have read the book. But for people who are new to this term and this concept, let's start by explaining it. What is a 100 bagger?
Yeah, 100 bagger, very simply, is a stock that returns $100 on your investment of every dollar. So if you invest in $1 in a stock and it goes to $100, that's a 100 bagger. Very simple. And it kind of comes from, Peter Lynch, famous investor back in the 80s and 90s. He used to refer to 10 baggers. So I just added a zero there, 100 baggers.
You're just a little bit more ambitious than Peter Lynch.
A little bit more, yeah. And people are telling me I got to add another zero. It's talk about 1,000 baggers.
Yeah, right.
Maybe another addition.
Yeah. Well, the interesting thing is, in the time period you studied, there was, I think, about 365 baggers, which surprised me just how many there were. I'd be fascinated to know how many thousand baggers there were. I'm not sure if you've got that information at hand.
I don't, but that's important to note. When we say there are 365 baggers, that means they at least were 100 to 1. Many of them were well above that.
So I reckon a lot of people would be surprised by that because, you think about these sort of unicorns or the gold standard when it comes to investing, and you think there might only be a couple of pitches every decade, but there's more than that. For people trying to get their head around what a 100 bagger looks like, can you share a couple of examples from your book?
Yeah, so, in the book I had a wide variety of examples because there are some that did it in a very fast amount of time. So Monster Beverage was a 100 bagger. I think it was inside 10 years and eventually was up more than 700 times. That's more of a high growth, big returner. But there's also, on the list, there are slower growers like Pepsi or Comcast or Coca-Cola, and they took 25 years to get there. And then even in the book, there are some that were even slower than that. It took 35 years to get there. So we're not talking about stocks that went 100 to 1 overnight. Usually they took a lot of time to get there. And in fact, in the study, you mentioned 365 names. You can imagine kind of there was this bell curve, and most of them kind of settled in that 20 to 25 year range.
Yeah, Monster Energy is the one that just gets me every time.
Yeah, that's a great one.
You see the Monster Energy drink on the shelf, and you just think of it in a completely different light now.
And what I love about that one too is that you could see it kind of in the numbers. I mean, you could see the high growth rates and earnings exploding and margins going up. You had years, to buy that. So, and still make 100 times your money. So interesting story.
Yeah. It is a fascinating one. So I guess for investors, they'll read your book and they'll be excited on that hunt for the next 100 bagger. And in some ways, I guess every 100 bagger is unique. Every company is on its own journey and it's got its own, defensible competitive advantages and the like. But there are some sort of common traits that you have drawn out that you see across all of these 365 companies. And the first one, the first two, you've labeled the twin engines of a 100 bagger. So let's start there. What are the twin engines? What do we need to be looking for?
So twin engines, one would be a lot of growth. So the companies that became 100 baggers, obviously their earnings exploded a lot. So so the one engine is you have this massive growth in earnings. But then the other one, maybe overlooked, the other engine is also an expansion in price earnings multiple, or expansion in how those earnings are valued in the marketplace. So if you buy something today that trades at, let's just say, 10 times earnings, and then it trades for 40 times earnings 20 years later, let's just say, that's 4x just on the multiple. And that helps a lot because you think about the math of that. That means you only have to increase your earnings 25 times. And then you've got a 4x multiple on the multiple, and then you get your 100 times that way. So it's this math problem, a mix of earnings growth and multiple. The multiple can help you.
Yeah, it's an important reminder that it's even when you're a growth investor and you're looking for these sort of like high-flying growth stocks that you think will compound for years to come, valuation and your entry price is very important.
Yeah, and I mean, because the engine can work the other way, right? You could buy something at 40 times and trades for 10, then you've got quite a drag. So ideally, you want that multiple to at least not hurt you.
Now, when we're looking at the growth side of it, there's obviously a lot of different ways for companies to grow, and we see sort of inorganic growth where companies will be buying other companies and bolting growth on, or we'll see companies reinvest their earnings. Did you see any particular type of growth sort of outperforming or leading to more 100 baggers?
I'd say in the study, when I wrote the book, the focus was more on companies that reinvested, and so they were able to compound those earnings over a long period of time. But since I wrote the book, I've learned a lot more about companies that are very successful doing serial acquisitions, just smaller acquisitions, but doing them again and again. So like a great example, that would be Constellation Software, which maybe people may or may not know is in Canada, but that's kind of the prime example of that model. And there's certainly a legitimate avenue to grow. And in the book, I also talk about some of which are much rarer, but some of the companies that did it by just devouring their own stock, by just using a lot of cash to continue to buy back their own stock. And so even though the businesses did not grow that much over time, they still delivered that outsized return because the equity base was shrinking and shrinking and shrinking.
Geez, that's a textbook example of capital allocation there.
Those are rare, much harder to find. But I'd say over time, as I've studied these more and more, I'm more indifferent to whether or not they get there by organic, which would be like McDonald's opening up new restaurants. That's organic, or inorganic growth, which is acquisitions. I'm really kind of indifferent to either one. As long as with acquisitions, it has to be. The evidence is it's better to do it when there's lots of acquisitions that are smaller rather than occasionally doing some big splashy acquisition. Those tend not to work out as well.
Now, another element that was common amongst a lot of these companies was economic moats. And most people listening have heard of this term, have heard Warren Buffett talk about them. But moats, I guess, are easy to talk about, but often hard to find in reality. So when you were looking at these moats, and I guess now, you're managing money at Woodlock House, and when you're looking for moats in your day job, what are you looking for, and what are some of the hallmarks of like really sustainable moats?
So the concept is simple enough. If you think about, you want to own a business that's earning very high returns on capital. So, let's just say, you put $100 in the business and it's throwing off $50 in profit. That's an enormous return, right? And we know what happens in those situations is that you're going to attract competitors because people are going to look at you and go, wow, look at this guy. He's getting 50% return on his capital. What is he doing? And they're going to want to copy it. So that's why a lot of these great businesses then have competition. So what the idea of studying moats is you want to find out why that business is going to be able to continue to earn those high returns over a long period of time. And again, we talked about 100 bagger, the bulk of them are in that 20 to 25 range. You're going to have to hold the stock for a long time, years and years, and you want to have some assurance that they can continue to do what they're doing. So what kind of moats do I like and look for? Well, I mean, to me, the better that it's rooted in something, it has to be something that stands out. I really don't like a moat that's just based on, say, a brand or something like that, because that can change. Brands lose their power. Everybody can think of examples of a great brand that's not so great anymore. So I'll give you an example like this company I own called Copart, which runs an online marketplace for salvage cars that have been totaled in accidents. And they own a lot of their own real estate. So they have these cars on real estate that they own. And over decades time, they've built up this huge network of real estate. It's very difficult to replace or replicate. And if you wanted to start and get into business against Copart today, it would cost billions and billions of dollars. And even if you had all that money, it wouldn't be any assurance that you'd be able to replicate the land that they have and the online marketplace that they've built. So they've got tens of thousands of buyers from all over the world on their marketplace. So these are things that are really good moats because they're hard for a competitor to replicate.
And I think it's important to stress that these businesses don't have to have some crazy technological advantage or anything like that. Like some of these companies are, like Campbell Soups was 100 bagger, or Union Pacific, the railway, was 100 bagger. It's like these moats are often more obvious than we would expect. They've got a cost advantage or they've got an infrastructure advantage. But it's just it's incredibly defensible, like you've said there, decades of building up land. And
those are the things I like the best, the ones that are really the result of a lot of time and investment that makes it very difficult. Just being a technological leader is not really a very strong moat. I mean, there are plenty of examples of companies that had a technological edge for a long time and then lost it. Somebody came along with a better mousetrap, whether it was Kodak, who got replaced with digital film or Polaroid, or I don't know. I'm sure there's a lot of even, you could maybe say somebody like Intel today is suffering through that. People have innovated around them. So I prefer other kinds of moats. Yeah.
Yeah. So then there are two elements that are preferred, and these weren't universal, but obviously they helped. One being a smaller company, which is intuitive, but it'd be good for you to just, talk to, the maths and why smaller companies are preferred.
Yeah. So, I mean, if you're buying Apple today, it's $1 trillion market cap. It's going to be, hard to imagine getting 100 bagger from here, so yeah, that's intuitive. It's easier if you're starting off with a small concept, let's say a restaurant that's a regional restaurant and it's worth $400 million and they're not even, still got the rest of the country to expand and they got, global markets, and you can just imagine this enormous market that they can grow in. That's the simple intuition there. And on the opposite side, if you're investing in these large giants, you have the law of large numbers working against you. So it's much tougher.
When you wrote the book, I think Apple was $750 billion market cap. And so you explained for it to be 100 bagger from here, it would have to get to 75 trillion. And that's 4 times the size of the US economy. So
yeah, that's right. It has done pretty well since the book. I don't know what the market cap is exactly today, but
it's over 3 trillion now.
It's
so
over 3. Yes.
yeah.
I was to say when I said a trillion, actually, I know it's more than that.
Yeah, it's crazy.
Which is incredible and mind blowing.
Yeah.
So that's one thing I would say too. I don't want to be too like dogmatic about it. I don't want people to like turn away from a great company because it's worth 10 billion or 20 billion. I mean, really, And in the book, I think I remember writing that 300 million was kind of the number because I was looking at kind of the whole study and what that starting market cap was. But I would, if I were rewriting it today, I would say you can go bigger. I wouldn't pass on something that checks all the boxes, but it's a $10 billion market cap or $20 billion market cap. I would still do it because you never know. I mean, over a long period of time, who would have guessed Apple would be worth over 3 trillion even 10 years ago? I think it would have been incredible to believe it. And so, the great businesses are what you really want first for beyond all that.
Yeah. And then a final element that's preferred, and this is something that we hear from a lot of experts that we get on the show, is a preference for owner-operators. So if you can just talk to that preference and some of the companies that you saw, I guess, deliver on it.
Yeah, most of these great businesses, they had some entrepreneur that was a driving force for them for a long period of time. So you can just drop names of companies and you'll think of people. Walmart, you think of Sam Walton, Apple, you're going to think of Steve Jobs, Charles Schwab. Well, Charles Schwab, they're not always, this is why it's preferred, but there was often a brilliant entrepreneur that drove that thing in the early years for a long time. And so that's the logic behind that idea.
And then, so you add all those elements together, lots of growth and a low multiple, a sustainable economic moat, a preference for smaller companies and owner-operators, and then you just add in time.
That's the dream recipe right there, Alec. That's what you want.
Your book makes it seem so easy, It's like, there's all these companies out there that will make you 100 times your money. Christopher, we're going to take a quick break here to hear from our sponsors. And on the other side, I want to put these elements, these common traits of 100 baggers into practice and ask you how you start actually filtering the investment universe today for these stocks with 100 bagger potential. Welcome back to Equity Mates. I'm speaking to Christopher Mayer, the author of 100 Baggers, Stocks That Return 100 to 1 and How to Find Them, and the co-founder and portfolio manager of Woodlock House Family Capital. So you mentioned there that the average time is about 20 to 25 years, and Monster Energy was one company that managed to do it in a lot shorter time. I guess give us the range of time, and was Monster Energy the quickest?
I don't think it was the quickest. I think there was a company that did it in 7.
Oh my God.
I think it was, I want to say it was Franklin Resources, but there was one of those things where the timing was, if you bought it, like the depth of
You've nailed it, Franklin Resources, but it wasn't 7 years.
Yeah.
It was 4.2 years.
Oh God. 4 years to 100 bagger. That's
unbelievable.
I knew it was very fast, but that's a real outlier. I mean, we've had some pretty quick ones, even recent times. Nvidia was, if you do the math on when that became 100 baggers, definitely inside a decade.
Yeah.
So there, even now, right under our noses, there's 100 baggers being born, so to speak, and rapid rates. So
yeah, that's the exciting thing about the stock market. I'm looking at this table, and there's some pretty well known names here in the fastest to 100 baggerdom. Time Warner 6 years, Dell 7 years, Cisco 7 years, Hasbro the toy company 9.5 years, Southwest Airlines 9.5 years, Home Depot 9.7. So it's not like, those names are obviously more known now than when they started their 100 bagger journey, but they're pretty well known names.
Yeah, and also what I like about that is it's not dominated by any particular industry, right? It's not like they're all tech names, or that's what people I think suspect. But then when you actually look at the data, it's a wide variety of industries. You got, like you said, a toy company in there, all kinds of things. So
Yeah.
More important, I think, are those underlying characteristics we talked about before. That's more important than any kind of industry affiliation.
So you wrote this book. It's a fascinating study of some of the best returns of all time. And you're now the co-founder and portfolio manager of Woodlock house family capital, and I imagine at least part of your day is searching for those next generation of 100-baggers. So how does that search play out in reality? Where does it start? What are you filtering for, and what does your research process look like?
Yeah. Well, I mean, it's not easy to find them, but I mean, you got to have the love for the hunt too. So, I mean, I like, studying these businesses and learning about them. And so for me, it's not as systematic necessarily. I mean, some of its screens have turned up businesses with very high returns on capital. So, what does that mean? I mean, you can look at return on equity is a pretty common metric you could screen on. A lot of screeners have that. The thing about it, you got to be careful there is companies can juice up their return on equity with debt. So you usually have to marry return on equity with something else. And you're going to have to look at them all anyway, right? So you just get a screen to kind of help sort out, because there are tens of thousands of securities to look at across the world. And you want to find some way to kind of sort things down to a more manageable list. But for me, a lot of it is just reading, talking with people in the industry, other investors, and a lot of digging around, snooping. So I wish I could give you something like more tangible and systematic for how I find ideas, but sometimes it's completely random. Like one of the companies I really love that I think has a definite shot, being a 100-bagger. I won't say it because it's very small. I'm not going to put that burden on but I mean, it's just so random about how I discovered them. It was almost by accident. Yeah. I mean, that's one part about investing, that it's just kind of, like I say, you got to have the love of the hunt.
Yeah.
Like to turn over rocks and look at names.
People often get frustrated that there's not an easy answer to it, but I have to remind myself that if there was an easy answer, quants would arbitrage that
Quickly
opportunity away,
Sure.
and Renaissance technology would take all the returns and would be left with nothing.
Sure.
Like the fact that it is a hunt and that it is ambiguous gives us the opportunity to make money.
That's right. And a lot of it is qualitative. A lot of it's understanding the business and stuff that just takes some time to go through. And, the thing about it, I remind myself too, is you only nearly need one. I mean, it'd be nice to get more than one, but you really only need one to kind of have that life-changing amount of money happen to you.
Yeah. And if you find a Franklin Resources and you do it in 4 years, then your life can change, in the blink of an eye.
All right.
So one thing that I was thinking when I was reading the book is the, I guess, survivorship bias. We look at people who are successful or companies who are successful, and we look at the traits that they had, and we say, well, those are the traits that must have made them successful. But the problem is there are also plenty of companies or plenty of people that had those same traits that didn't make them successful. So it's the attribution of like what actually led to success is sometimes quite difficult. How do you think about that problem when you're looking at this cohort of companies?
Good question. I mean, I think some of it, because this is, we're looking at companies that went up 100 times, at least 100 times. So you either did it or you didn't do it. So it would be interesting to see how many companies had, say, very high returns and had the owner operator and had all those, but didn't quite get there. I think that would be a more difficult study to run. I think it might be more practical to do one where you look at the companies that went up 100x and then after that point became, disasters or lost their status. That would be more reasonable to do. I think that could be done, and you could go back and you could do all kinds of case studies on Polaroid and so on. I haven't done this in a systematic way, but I just know intuitively from looking at them that there are several ways where companies get in trouble. And it's not really going to surprise you. The big one would be debt. Lots of companies, even though they had very good businesses, they didn't get there because they didn't have the balance sheets to withstand the inevitable economic storms. I mean, if you're going to go 20, 25 years, you're going to see more than one recession. You're going to see several different busts along the way. And if you don't have the ability to get through those, you're not going to get there. So debt is like the number one, I think, impediment, destructor, destroyer, whatever you want to call it, to these great companies. And the second one, I think that was more intuitive, again, would be some sort of obsolescence. So lots of companies had something for a while, and then they were just, for whatever reason, became obsolete. I mean, the newspapers examples are famous, but I'm also thinking Polaroid, which was a spectacular stock for a long time and then went to almost zero. I mean, so any kind of technological obsolescence can be very deadly. But so those are a couple things I think stand out. But that's a good question, and that's something you definitely have to keep in mind? Like, what are some of the big stumbling blocks to getting there?
Yeah. So, I've mentioned before that you're allocating capital at Woodlock. How do you think about building a portfolio with this 100-bagger, idea in mind? Would you be building a portfolio full of companies with long-term 100-bagger potential, or do you have to balance that long-term vision with shorter-term incentives and shorter-term return hurdles?
Well, I think it'd be wonderful if you could fill a portfolio full with 100 bagger type names, but I think you're not going to find that many.
Okay. Well, you found 365 of them, so.
Right, I did. So as a practical matter, it will take you some time. So you might have one, and then you might add another one, and then you might add another one, and then maybe over time you will get to a portfolio where you have a full portfolio of, let's say, 10 to 12 names that you think each have a shot at making it. I'm just telling you that you're not going to get there quickly, and it's going to take some time. In the meantime, what I do is, again, focus on those underlying characteristics. And then, so I've bought companies where the market caps are larger and where maybe if I were to look at it, say, probably not 100 bagger, but they have those underlying characteristics. I mean, they do have those high returns on capital. They're reinvesting at high rates. All my companies have, they're insiders, a lot of skin in the game, owner operators. So, we'll see. I mean, the math is the math, and maybe a couple of those will surprise me. But from the way I run the portfolio, it's entirely this kind of method, in that I'm focusing on the long term and the compounding. I'm not necessarily looking at the 100 bagger. The 100 bagger would be like the outcome. I'm focusing more on the kind of the process and all what I like to call the engine that kind of behind them, the engine that gets there.
Yeah,
and then let the outcome kind of take care of itself.
One thing that when we're just talking about the elements of 100 baggers, one thing that we didn't speak about, and I'd be interested to get your thoughts on whether this matters at all, is market size. We don't say this company is operating in a market that is massive or is going to be massive, and therefore it has 100 bagger potential. Does that matter, or can the best companies become 100 baggers in any industry?
Well, I think it matters. But, I wouldn't let that constrain you too much, because sometimes the best companies then find other ways and create new verticals and get in adjacent markets, and they find ways to continue extend their growth. So, yeah, I would say you need that big TAM. I mean, we could look at examples. It's a classic example. Let's just look at Amazon. I mean, when Amazon started, it was a bookseller, an online bookseller. That was it. So I remember distinctly reading, stock write-ups and analysis from, I think it was like late 90s, when it was getting really frothy, and people would do this thing and they say, well, even if Amazon captured the entire book market, it doesn't justify the market cap. Nobody was thinking that they would sell all this other stuff that they sell. Nobody could imagine that they would, have AWS, one of the world's largest software, inside it. So, that's what makes it difficult. And even with Apple, they created whole new markets that people, would have a hard time imagining when they were looking at it before these markets were created. So it's just fascinating to see how some of these great companies are able to extend their markets.
Yeah, it is. It's pretty great that we can just go along for the ride and do no work and get all the benefit as shareholders.
That's right. Of course, the work is you got to hang on to them, which is easier said than done.
Yeah. The work is in controlling your own mind.
Yeah.
So your book is one of the best-known investing books, widely read around the world, and I'm sure there's hundreds of thousands of people trying to implement the lessons in it and implement what they've learnt in their own investing portfolio. When you're speaking to people or when you're seeing stuff online, is there anything that people often get wrong when it comes to the work that you've done? Are they implementing it in the wrong way? Any common mistakes that you're seeing people make that we can avoid?
Well, I still think a common mistake, if we use that word, is it's very hard for most people to get away from the macro. Everybody wants to have an opinion on where the economy is and whether or not there's going to be a recession or not, and what interest rates are going to do, and what central banks are going to do. That is hard for people to get away from. And that's really a distraction, I think, that quest to 100 baggers. So that's one. And then two, another one I think is sometimes people get overly concerned about valuations. So, the way I think about valuation is, I look at it over, I go at least 10-year period of time, kind of forecast what, you have a certain return on capital of the business today and it's reinvesting. And so you see, if it's compounding at 25% a year, whatever, it's going to have 10 times as much capital in 10 years. You put a multiple on that and you get your IRR back to today. It's that kind of analysis. And when you do it that way, you can see that you can pay up quite a bit for a really high quality company. Some of the multiples I think are surprising to people. So, they don't want to look at business. They think it's expensive at 35 times earnings or 40 times earnings. And when you extend out the math and think about it, it's not expensive at all. In fact, the market seems to persistently underprice those kinds of businesses. So there's actually an opportunity if you're willing to look at. So some people, if you make valuation your first criteria all the time, it's going to be very hard for you to hold on to a business for 20 years because there are going to be stretches where it's going to be overpriced and it's going to look expensive, and you're just going to have to hold your nose and take the ride. So those are two mistakes I would say that I see people make when they try to do this. Yeah.
I think we've spoken about Amazon before, but it's really the classic example of that. The old truism was that Amazon always traded at a 60 PE, but it just kept growing, and it always looked expensive, but it just kept growing.
And I'm sure you've seen different. I know Terry Smith has done this. Other money managers have done this, where they look back at a stock and they say, what you could have paid, what P you could have paid 20 years ago and still made at least 10% or whatever, 15% annualized return. And it's always an astounding number.
Yeah. Just got to find the right company.
Right, if you got the right company.
Yeah.
So that's really the key.
Yeah.
I'm not saying because of that you should just go off willy-nilly and buy things that trade at 100 times earnings.
Yeah.
I'm just saying, that you put that business analysis focus first and really, focus on that part. And the valuation is the second piece behind that. Don't let the valuation lead you necessarily, because it will scare you off of some very, really good companies. The market's not dumb. Sometimes the really great businesses they trade at high prices. Just like anything else in life, the really good stuff seems expensive at first, but it's often worth it.
Yeah. I think that's a good note to end it on, Chris. I want to say a massive thank you for joining us today on Equity Mates. If people want to read Chris's book, it's called 100 Baggers. You can find it wherever good books are sold. He has also written 3 other books that you can pick up wherever books are sold. So, Chris, a massive thank you for joining us today.
Yep. Good, Alex. It's been a good conversation, good questions. Fun to be with you.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.